Hey everyone, welcome to this explainer. Today we're diving into something that is absolutely crucial for any real estate investor, structuring a truly robust chart of accounts. Whether you're managing, say, a couple of duplexes or you've got this massive multi-state portfolio, the source material makes one thing crystal clear. Your financial architecture literally determines your ceiling for growth. So let's unpack this blueprint for scaling with total clarity. Okay, let's dive into this. We've got to start by calling out a very real pain point. Look, if you're managing multiple properties on just a basic ledger, you already know the struggle, right? Rent comes in on all these different schedules, maintenance bills pile up, security deposits need careful handling, and trying to figure out which dollar actually belongs to which property, well, it can feel like a totally messy guessing game. The source material actually captures this soul-crushing reality of bookkeeping perfectly. It says a spreadsheet can track one property. It starts to crack at 3. By 10, it's a liability. It really is. When a basic system fails to scale with an expanding portfolio, it doesn't just create a massive headache at tax time. Worse than that, it actively masks inefficiencies and quietly bleeds your net operating income dry. So here's our roadmap for today's explainer. First, escaping spreadsheet hell. Then we'll hit the 5 accounting pillars: real estate's unique demands, mastering dimensional tracking, protecting the general ledger, and finally, scaling with financial clarity. Let's get into it. Section 1. Escaping spreadsheet hell. As your passion for real estate smacks head-on into the cold reality of accounting, we really have to recognize that messy finances murder both your profits and your sanity. Standard business accounting just doesn't cut it here. Generic bookkeeping lumps everything together, kind of treating your entire portfolio like a single lemonade stand. And relying on shoeboxes of receipts or duct-taped systems, that is a one-way ticket to missed deductions, compliance nightmares, and frankly, boneheaded business decisions. Simply put, you just cannot manage what you don't accurately measure. Section 2. The 5 accounting pillars. Think of the chart of accounts as your absolute architectural blueprint. It's literally the DNA of your real estate business. Every single transaction you make, no matter how small or large, falls neatly into one of these 5 structural load-bearing pillars. We're talking assets, liabilities, equity, income, and expenses. And this brilliantly illustrates our foundation. So what does this actually look like in the real world? Well, assets are things like the property itself, your cash, equipment. Equity is your initial investment and retained earnings. Income, that covers base rent, maybe pet fees or common area maintenance charges. And expenses, of course, include your maintenance, property taxes, and insurance. But, and this is super important, pay close attention to liabilities. Yes, this includes your mortgages, but crucially, it also includes security deposits. Those deposits are liabilities held separately. You owe that money back to the tenant, so it is never commingled with operating cash. Absolutely crucial to get that right. Section 3. Real estate's unique demands. Now we need to shift gears and look at why generic accounting setups completely fail landlords and property managers the second they start adding more doors. Now, what's really interesting about this juxtaposition is that a standard business setup just lumps all maintenance into one generic repairs bucket. But the real estate approach, it requires surgical precision. You need granular tracking per property, per unit, and even per legal entity, so you actually know which specific asset is performing and which one is just draining your cash. Real estate operations have some incredibly specific complexities. You have to separate routine operating expenses from capital expenditures, like putting on a new roof. And let me tell you, misclassifying a CapEx item as a standard repair, that is a massive audit trigger. You've also got multi-entity and multi-unit reporting, strict trust accounting for tenant deposits, and those complex CAM reconciliations for commercial spaces. A specialized structure isn't just a nice-to-have, it's practically mandatory. Section 4. Mastering dimensional tracking. This brings us to the real secret weapon for growing portfolios: dimensional tracking. Basically, this is the ability to tag every single transaction to a specific property, unit, and entity simultaneously, without having to create thousands of separate ledger accounts for each one. Think of it like the electrical wiring running right through the foundation of your business. It lets you sort and filter your data in 3 dimensions without muddying up your core accounting structure. To see why this is so insanely powerful, let's look at a specific example. Imagine you pull a report using dimensional tags and you notice your landscaping costs at one specific property jump from $500 in months 1 and 2 up to $750 in month 3. Property-level dimensional tracking immediately highlights that actionable financial inefficiency. Instead of just seeing a vague, generic bump in your overall portfolio expenses, you know exactly which property has a variance. You can literally pick up the phone, call that specific vendor, and find out exactly what happened.
Section 5. Protecting the general ledger.
Now, it's one thing to understand the theory, right? But it's a whole different ballgame to maintain order within the system as you scale up. A true general ledger is that master list tracking those 5 pillars we discussed earlier, strictly using double entry bookkeeping. It is not just some glorified cash summary showing money in and money out. It is the audit-ready core of your business. And because it's the core, it has to be fiercely protected from becoming a chaotic, muddy mess of highly specific sub-accounts. So to keep that core ledger pristine, you follow a really clean procedure. Step 1, you set base general ledger codes, like having just one single code for maintenance. Step 2, you apply those dimensional tags we just talked about, so you tag that maintenance to, say, Property A, Unit 2. And Step 3, the system generates both your consolidated portfolio reports and your granular property-level reports. Let's move on and see how this builds our reporting capabilities for the future. Section 6, Scaling with Financial Clarity. Research points to an incredibly important threshold, and that's the 20-unit mark. This is the critical point where transaction volume, lease variations, and maintenance requests just completely outpace what spreadsheets can reliably handle. If you cross this threshold without a structured chart of accounts and dimensional tracking in place, your reconciliation errors and compliance risks are going to compound at an alarming rate. But getting this right, setting up this architecture, literally transforms your raw data into a strategic weapon. As this quote highlights, the ultimate goal isn't just to ditch a spreadsheet, it's to reclaim your time, vaporize costly errors, and get the financial clarity you need to make smarter moves. It makes tax season an absolute breeze because every single deductible expense and capital expenditure is already perfectly categorized, properly tagged, and completely audit ready. So I'll leave you with this. Is your accounting system building your empire or holding it back? A chart of accounts is either a rock-solid foundation ready to support a skyscraper, or it's a crumbling liability. I really hope these insights help you audit your own ledgers and scale with total confidence. Thanks for joining me for this explainer. Keep building, and we'll see you next time.